Good morning and welcome to the Shanta Gold investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged to be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in position to answer every question it sees during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand over to Eric Zurin, CEO from Shanta Gold. Good morning.
Good morning, Zach. Thanks everyone for joining. Today we'll be going through the presentation on our Q4 results that we announced this morning and give you some color on all three of our assets, where we are in terms of production, development, exploration, and also give you a flavor for 2022 guidance, which we've deliberately added a little bit more detail this year to ensure everyone's up to speed with what the year looks like. And I think that's really important for us to be transparent around that. I'm Eric Zurin. I'm the CEO of Shanta Gold. I'm delighted to be back on the platform with Investor Meet and with our followers. And look forward to answering all the questions we get at the end of the webinar and to being in good communication with our shareholders. Now, just as we begin, I'll just come off the screen and I'll take you through the various slides. Beginning on slide 3, which is an update on Shanta. And now, obviously, despite some challenges we had in 2021, and I'm all too aware of what those were, we are very pleased to have exited the year in line with the revised guidance. And most importantly, forecasted production growth of this current year, 2022, up to 68 to 76,000 ounces of production. Now, our robust fundamentals that underpin the business, they continue to strengthen. So remember, we have an excellent safety record, we have a very strong balance sheet, and we have a self-funded exploration development program. What does that all mean? Well, it means we have cash on the balance sheet, we have access to liquidity, and we have cash that we're generating from our producing asset that will fund the construction at Singida and the exploration at West Kenya. We also have a lot of flexibility around those plans, and so we can optimize the plans in line with the cash flow that we expect and the liquidity that we have. So we are responsibly investing money, and we're not overspending in any single area. What's the outcome of all this? Well, in 12 months' time, I hope to be sitting here telling you that Shanta will be a 100,000 ounce plus gold producer when Singida comes online as the next large-scale gold operation in Tanzania. So Singida is expected to add about 35,000 ounces of gold production in its first year. Why is that important? Well, because Singida will add a second revenue stream, so we'll have a diversified revenue stream, which reduces risk. We'll be more relevant, having 2 assets producing gold instead of 1, and we'll be bigger because we'll be generating more cash flow. So those are all the positives around why this year is so important to us. Now let's begin on slide 3 of the presentation. As I said here, that's the slide we're on now. Just to remind you of some of the highlights of Shanta. So Shanta has a diversified portfolio in East Africa of gold assets. So we have 3 assets in 2 countries, and we think the evaluation is incredibly attractive at this level. We've operated in Tanzania now for 20 years. So it's a country we know incredibly well. 99.4% of our employees are Tanzanian, and we have super good access to the right people in country. We've been producing at the New Luika gold mine for 10 years. Again, track record is everything. We've been there a long time. We know how the country works, and we've been successful at producing gold without any interruptions since 2013. Now, really, over the last 3 years, the last 3 or 4 years, really, we've undergone a transformation. So this is the first year, really, that I think it's all about getting the job done. Getting our second asset into production by the end of the year, early 2023, setting a new production level above 100,000 ounces on a run rate basis for the first time in Shanta's history. And from my perspective, since 2018, the team has done an incredible job of broadening our portfolio. So again, 3 assets in 2 countries. We basically eliminated all of our debt. We moved to an unhedged gold sales position. And we've got this portfolio now that we're investing in, which is incredibly exciting. Yes, it takes money to invest in these assets, but we think the risk reward for the investment today is is far outweighed by the potential reward over the longer term. Now we're backed by some fantastic shareholders. Odie's been in the as a top shareholder now for I think it's nearly 8 or 9 years. The directors are invested, including myself, and a number of really good London and London-based shareholders. On to slide 4 to give you a feel for what does the next 5 years look like, and then we'll dive into each asset in the 22 guidance. So last year in July we announced our 5-year plan. This includes revenue from the Singida and New Luika mine starting in 2023, and then moving up to the 3rd asset, West Kenya, planned for production here in 2025. So we're in a growth phase. I mean, don't be confused. This is the growth phase for Shanta. This is all about investing cash flows into building out growth and realizing that growth potential. So what's important out of these 3 assets? Well, at New Luika, we're producing now. So this is the 68 to 76,000 ounces in 2022. For us, the strategy there is reserve life extension. How do we add more ounces to the mine plan at the cheapest amount possible to realize the most amount of cash flow? Remember, all of the capex, or substantially all of the capex in New Luika, is already invested. It's already in the ground. So it's all about pushing that mine plan out. And shortly, we'll be providing an update on our reserves and resources at New Luika, which have had, I think a very good, a very good year in 2021, and we'll be providing some updates on that. Then the second asset, Singida, it's all about getting that construction on track, which it is, and moving that project into commissioning and production. And then our 3rd asset here, really around West Kenya, is about the resource upgrade from inferred to indicated, and then the resource expansion across this super exciting district, this greenstone belt in the Lake Victoria region. So as you can see here, annual growth or annual gold production is set to rapidly grow. It's averaging about 116,000 ounces a year from 23 to 25. This year, 22 is a step up from last year, and then 23 will be another step up from 22. And these are all reserve-based plans. So this is the kind of highest confidence level of the resources in the ground. Moving on to slide 5, which is just a recap of what we did in Q4 and some of the year. So during the quarter, we produced 12,244 ounces at a gold grade of about 2.0 grams per ton. This was as expected, as we set out in early December, as a result of a supply chain issue we had with our emulsion provider during the quarter. Liquidity remained strong. At the end of the quarter, we had $15.9 million of liquidity. We had another $4 million undrawn from a working capital facility with Standard Bank, and then another $4.3 million in VAT refund that was verified for approval on January 3rd. So combined, that's over $24 million of liquidity, plus the cash flow that we're generating from our producing mine, plus any additional balance sheet capacity from debt if we so need. So we believe we have the liquidity and the cash flow to realize the growth plans that we've set out. The intrinsic value at our non-producing assets, Singida and West Kenya, I think is super compelling. It's a core part of our growth plan, and combined, that adds about $400 million of NPV at $1,700 per ounce gold. So a lot of upside certainly from those 2 assets. Now on to slide 6, if I may, and that is a discussion here on safety, which is obviously the top of our priority list in terms of a gold producer. I was on site about 10 days ago. I'll be back in about a week's time. I'll be back there next Monday. Safety remains excellent. It's a core part of our culture and DNA. We've now not recorded an LTI in over 4 years. That's something a lot of companies, most companies can't say. And I think it really is down to the culture on site, if I had to be honest. Our injury frequency rate is 0.89. It's the lowest it's been since 2017, at least 2017. And it's something we're incredibly proud of. That's really important to the workforce on site. Moving on to slide 7 of the presentation, and just a few numbers to highlight here to take you through. As I mentioned, we produced 12,244 ounces of gold at 2 grams per ton. But the real marker here for us was the notable step change, both in terms of throughput in the plant and also tons mined from the open pit underground sources. So really it's a trade-off. When the reserve grade, if you go back 5 years, you'll see year on year the reserve grade reducing, which is that's what we've been given. That's the set of cards we've been dealt, and our job is to make sure that we can continue to operate with the reserves that we've been given. And so the way to mitigate the reserve grade decrease is to expand throughput. Simply put, you're processing more tons, your fixed costs don't change, and you can take on, ideally try and hold top line production the same given a lower reserve grade. And so that's what we did. We increased the plant by about 17% year on year with the addition of mill number 3. We are looking very closely at mill number 4 as a potential opportunity, but still the work isn't quite done yet, and that's certainly helped us a lot in getting more throughput at a lower grade. Also of note here really is on the tons mined, where we've increased open pit and underground mining by about 13% year on year. And remember, this is despite COVID, despite supply chain challenges, despite a lot of headwinds that we've had to deal with. We're basically using the same workforce to move more physicals, which I think is a great testament to the team. Now, obviously, on the same page, you'll ask, why is production lower? Well, that's driven by grade. In Q4, we were specifically mining more from development ore because we couldn't get the production ore out with the challenge we had around the charging unit and the emulsion from that supplier. That's been rectified, and in fact, we've placed an order for an additional charging unit, which we'll expect to have in sometime in Q2. So that'll give us, I think it's a third charging unit on site. Again, just de-risking that production plan. Now, finally, I'll mention again, we're unhedged. It's the first year we've been able to say that. Gold sales have gone from $1,500 an ounce to $1,800 an ounce, and that's again mitigated the decline in grade for us. So it's a year of transition. We've had trade-offs, both pluses and minuses, and it's about making sure we have confidence in that plan to deliver the growth that we've set out for the coming year. Now, just on to slide 9, I believe it is here, the 2022 guidance, and on that coming year, what do we expect? How is it going to look, and how should you manage your own expectations? Well, the headline number is 68 to 76,000 ounces of production guidance, or of gold production. Now, if you kind of take that on board, come back to this presentation in 12 months' time, our objective is to hit that guidance, hit that range, and to be well on our way to seeing the first doré bar come out of the Singida processing plant. Now, of course, everyone's interested in how that looks throughout the year, and I'll give you a few words on that now. And as explained in this morning's RNS, we'll be mining from the very high-grade Bihini Creek crown pillar in about 100 days' time. And so the work's already started. The guys have commenced development to access that. They'll be in there. I think they'll be touching it in about 60 days, 55 days from now, and then be able to start attacking it once we're confident that the rains have largely subsided. Now, what's a crown pillar? What does it mean? Well, if you think about an open pit, so think about a kind of like a salad bowl, for instance. It's the bottom of that salad bowl where you can't take the crown pillar out until you're effectively largely done with the underground, because it prevents a lot of rain and water from getting into your underground workings. And back in 2016 and 17, we were mining at the bottom of that salad bowl, so the bottom of the Bihini Creek open pit, at very high grades. And you can go back and check the quarterly reports. I think 1 month it was 9,000 ounces in a single month, because of the very high grades. And so this is really a continuation of that. And there's a graphic on the slide which shows it's basically 3 sections of that crown pillar that we'll be taking out sequentially and then backfilling. And in total, this brings up about 83,000 tons, grading 8.4 grams per ton, containing 22,500 ounces. Now, what does that really mean? So the processing plant today can do about 75,000 tons of throughput. So basically, you're getting, for 1 month of throughput, you're getting 22,500 ounces of contained gold, which is the equivalent of 3 to 4 months of production as we sit today. So that's pretty good. That's incredibly economic and profitable, and that production is being timed to coincide with the demands around the Singida construction. And so this is, it's all been optimized in terms of our own cash flow and projections. Now, we're confident in the 2022 mine plan because we've done so much grade control drilling. 82% of the underground areas in 2022 have now had grade control drilling, which means we've effectively done infill drilling. So we've gone from, somewhere between 30 meter spacing, and we've brought that into between 15 and 20 meter spacing. So we have better predictability in the reserve model, which historically we've been able to mine roughly about neutral to slightly positive reconciliation against the grade control model. So that gives us more confidence in the 22 plan. Now, the mine plan as we set out is largely unchanged from the 5-year plan in July that we announced. We expect Q1 production to be similar to the recent Q4 level. That is as expected. That's not a change. That's as expected. And that's just a function of where we are in the mine plan. And so that production level will be increasing sequentially quarter on quarter this year as the grades step up, largely driven by the crown pillar. In terms of physicals, in the mine plan, about 24% of the physicals will come from the open pit sources. So that's mostly Elizabeth Hill. I was there again I was there about 10 days ago. That's a 1.9 gram per ton open pit area that'll drive about 11,000 ounces this year. And then about 76% of the tons will come from the underground sources, being Luika underground, and then slightly more from Bihini Creek. And as you can see on this page, the underground mine grades will average about 2.6 grams per ton in the first half, and then that'll nearly double to 4.8 grams per ton in the second half, really driven by that crown pillar that will be extracting. So hopefully that gives you a bit of color as to where the plan's coming from, the tons, how we've put it together, the timing of certain ounces, and the confidence we have in the plan given the grade control drilling that we've been able to do. Now let's turn our attention to West Kenya briefly on slide 10, just to take you through what we've accomplished and what we hope to communicate, or what we will communicate over the next couple of months. So last year we completed a record 32,000 meters of drilling for us at West Kenya. That included 4,000 meters at regional targets. And just, you can go back into the RNSs that we've announced. The results have been very encouraging. We'll have an updated resource estimate out toward the end of February. So don't hold me on it if it's the first week of March or if it's the middle of February. The guys are working flat out to get that work done, but it has to be done diligently, and we're working with an independent consultant who's signing off on all the work in Canada. So we've said at the end of February, and that will really be focused on new resources across the district, particularly at the Remula target, and conversion from inferred to indicated at both the Sulu and Bushingala. So what have we announced so far for drilling results up to the middle of the 30th of the year, 30th of June last year? We converted over 100% of the targeted inferred resources to indicated. So that's 117,000 ounces at 7.04 grams per ton, kind of eye-watering grades. And then we've since been drilling at Remula and more at Bushingala and Sulu. So we'll have another set of drilling results out this quarter. Now, most importantly, we've recruited a top quality feasibility study manager out of Canada who's relocating to Europe to help us with the feasibility study at West Kenya. He's spent a lot of time in East Africa, and he starts in May 2022 for expected delivery of the feasibility study in Q3 2023. That'll incorporate all of the infill and expansion drilling. So that's a good milestone, and really that'll take the West Kenya project to the next level. Now on to Singida briefly, and then we'll touch on a few other points and conclude and take some questions. As we said in the RNS this morning, mine construction is on track for early 2023 production. A couple key milestones we achieved during the quarter. We had the first blast at Singida, so that was the commencement of open pit mining activities, and we've since stockpiled, I think, just under 2,000 ounces of gold, contained gold on the stockpile. Last year we spent, we invested just under $11 million in capital and prepayments at Singida, and the project on a deliverables basis is 42% complete, which is on track with what we planned. Now, in terms of this coming year, what are some of the milestones we have to hit and we're planning to hit? Well, mining operation, the mining activity, so these are basically your yellow machines, are ongoing now, but will really be ramping up around March, April time. And that's in line with our revised schedule. Why is that important? Well, you have to move the waste rock to build the TSF. And there's a bit of flexibility in that because you can effectively add more equipment to the surface fleet to go faster. But again, that needs to be aligned with the cash flow that we generate. The TSF construction will begin. This is the tailings storage facility where you basically put all the slimes. This construction will begin largely in line with the mining operation. And we'll be procuring liners and HDPE pipes starting in February and March this year. On the processing plant, the crusher will begin to be commissioned in March. I think 15 out of 20 containers have now arrived on site, and Metso will be on site. Metso's they'll be on site to commission the crusher beginning in March time. Staying in the plant with the ball mill, the cyclone cluster, the gravity concentrator, these are all items that are required as part of the beneficiation process. The ball mill installation, which is probably the single biggest milestone to achieve, the ball mill will be commissioned, planned for May, and that's with a group called NCP out of South Africa. So that order was placed, I believe, about 10 or 11 months ago, and there's been a lot of work on that ball mill to get it into where it is today. A couple more points. We have Bulk Power, the Aleutian, we've just literally signed the contract with the group out of Australia on the Aleutian circuit. That's the item that goes in the gold room. So we've just signed that contract. I think it was yesterday, and that is about an 8 or 9 month lead item, which will be fitted into the gold room towards the tail end of this year, as part of the final smelting process to get your gold doré out. Bulk Power is underway with the main transformers, switchgear, which orders have been placed and will be put in place probably around Q2 April time is when we expect to start that work. So a lot going on at Singida, 268 people on site. Full recruitment's been done, and the team's motivated with certain completion KPIs as well to make sure that they achieve the outcomes that we've set them out to do. Now, moving on to slide 12, and for the first time in a long time, we've been able to have a positive update on VAT. And the headline here is, since July 2020, so 18 months ago, we've now had $11.5 million of VAT refunded, offset, or verified for refund. That includes $7.2 million offset and refunded last year in 2021. So for any doubters of VAT, the storm has passed and VAT is being refunded on a sustained and timely basis. That is, I believe we can draw a line on the VAT scenario. We've had now, I think it's 4 individual verifications or refunds since July 2020. That for me is a good track record, and the dialogue is positive with the Revenue Authority individuals. Now, where's the upside in VAT? What are we still waiting for? Well, the balance today is, as I said, I think it's about $27 million of VAT that's still outstanding, but of which $23 million relates to the historical portion from July 17 to June 2020. That's the area that's in dispute. We're having very good discussions with the Revenue Authority around that. We've had a lot of positive back and forth, and it's certainly a big number, and we're working hard to try and get that back. We would put that straight into Singida to make that project go as fast as possible, and we've said so much to the Revenue Authority, and so we believe that those conversations, we have confidence in those conversations, and we are committed to trying to get that $23 million refunded. Now, what does this all really mean for Tanzania? Because there's a bigger message here. Don't get caught in the weeds of VAT. The bigger story here is that the investment climate has changed in Tanzania for the better. Our evidence is that we have had VAT refunded. We've just last week had our mining licenses at Singida extended for another 10 years. There's been a number of special mining license applications and granted for a lot of groups in Australia. We've seen BHP invest $50 million into a nickel project in Tanzania, 7 to 14 days ago. These are all really good steps forward for the country. And, I don't want to say anything about other parts of Africa, but we think Tanzania and East Africa is a safe and fantastic place to be investing, particularly relative to many other countries on the continent. So we're excited by it. We've been in country for a long time, and it's about sustainability in these places, building trust with stakeholders, and making sure that we're well liked, and want to be welcomed when we turn up at the immigration desk at the Dar es Salaam airport. Now, finally, to conclude on slide 13, a few catalysts just to keep your eye on. A lot of you will already know these, but I'll lay them out anyway. We've alluded to an updated reserve and resource statement coming out shortly. That will be up to the end of December 31st, 2021, and that'll cover Singida and Luika. So we'll compare what we did over the 12-month period to give you a flavor of reserve replacement at Luika and what the grades look like. So remember, we have been drilling outside of the mining license at an area called Porcupine South, and we have had assay updates throughout the year. So stay tuned for that. We'll have another round of West Kenya exploration drilling results. We're just getting the final assays together from the end of just before Christmas period, and so we'll have those assays out to you when ready. And then hopefully in about a month's time, we'll have the West Kenya resource update showing what we've been able to convert from inferred to indicated on the back of the additional 15,000 meters of drilling since June 30th. And I believe we'll be able to demonstrate how the district is starting to shape up. Because for me, West Kenya isn't just about Asula and Bushangala, it's about the whole greenstone district that we want to unlock that has been effectively untouched and underexplored for forever. We're excited by the inaugural sustainability report. We've been spending about, I think it's better part of about 9 months working through that. We've had numerous interviews with our stakeholders, our shareholders. We've had a consultant help us think through what's important, particularly as a gold operator in a remote part of Africa. And I think what was most telling for me was the risk matrix that we undertook. And so that'll be updated in the next, probably the next couple of months. Full year results out, Q1 update, and then we'll be straight into that crown pillar that's so exciting from a cash flow predictability standpoint. With that, Mark, I'll pause there. That's the end of the formal presentation. I'd love to take some questions and communicate with our shareholders.
Eric, that's perfect. Thank you for your presentation today. Ladies and gentlemen, please continue to submit your questions using the Q&A tab situated in the right-hand corner of your screen. But just while the company take a few moments to review those investor questions, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Eric, as you can see, we received a number of questions today, and thank you to all investors for submitting their questions. Could I please ask that you read out the question and give a response where it is appropriate to do so, and I'll pick up from you at the end.
Great, thanks very much, Zach. So the first question here is, once the crown pillar has been exhausted, so it appears mined out, how will we replace the high-grade ounces mined in 2023 and beyond? Well, the short answer is, when we published our 5-year mine plan last summer in July, we've set out, the starting point is the reserve statement. So what are the reserves at New Luika? And the reserves, as they sit today, are about 3 grams per ton. And so that is the basis of the mine plan going forward, give or take. It's a reserve grade of 3 grams, and it's a throughput of roughly 880,000 tons per year. The high grade, unless we discover more, the high grade won't be replenished. That is just a function of the reserves. But things that we can control are things like plant expansion, and hopefully through additional exploration, we will be able to find new high-grade sources. But as it is today, the overall blended grade at New Luika is about 3 grams. Our second question is from Ramon. How confident are we that there will be no dilution needed this year? Are you considering a JV for West Kenya to reduce financial commitment and risk? By dilution, I imagine it could be one of two things. It could be mining dilution. So if I had to answer that, we're confident in that because of the grade control drilling that we've done. If it was equity dilution, in terms of a placement, we're confident in that and not having to do that because we have, as I said, about $24 million of liquidity today, and we have attractive cash flow ongoing throughout the year, including the crown pillar, and we have balance sheet capacity because we don't have any debt. So those are 3 key sources of investment that we can call on to fund our growth. Are we considering a JV for West Kenya to reduce financial commitment and risk? We don't have anything live at the moment where I would say we're opportunistic and my background is in banking, so we're quite commercial and reasonable about different propositions. But I think the reality for us is to make sure that we're achieving maximum value for West Kenya before we go and invite anyone else into it. In terms of Michael D, he said, great progress. What are the key milestones investors should look for in 2022? Well, let's just do it really by 4 categories: 3 assets and the balance sheet. At New Luika, the key milestone there is production. I've been reminded over and over, it's about hitting that guidance of 68 to 76,000 ounces and doing so, safely. And I must remind you, we've said quarter 1 will be similar to quarter 4, and it'll be ramping up from quarter 2, driven by the crown pillar. And so that is our key objective. Probably the top objective for the company is to achieve those production targets and to do it safely. In terms of other key milestones at Singida, it's to progress the construction of the Singida gold plant, gold mine, to get to that commissioning phase in early 23. At West Kenya, it's to convert more ounces into the indicated category and to expand the resource base in the district. And then with the balance sheet, it's to remain unhedged, minimize debt as much as we can, because debt is synonymous with risk. It reduces your flexibility, but it's there when you need it, which is good. And to make sure that we maintain in a healthy position. And ideally, we have a breakthrough on this $23 million of VAT. We're working hard on it. No promises, but I've always said we had a good dialogue with the Revenue Authority. So that's a key milestone, hopefully, that we can achieve this year. It is hard work. Believe me, it is hard work to have those conversations. JP has asked, do you foresee the need for additional funding to complete Singida? The shorter answer is, as we sit today, no. What we've done is we model our cash flows on a monthly basis, and we plan those cash flows against our production plans at New Luika. So what does that mean? Basically, it means we can optimize how we spend money at Singida, knowing what our liquidity is on our balance sheet and the expected cash flows from New Luika. And so as the gold price goes higher, that gives us more flexibility. And so as we sit today, we don't anticipate need for additional funding to complete Singida, is the answer today. Nathan has asked, what inflationary challenges are you experiencing? Equipment costs, wage increases? Great question. It's, you just have to open up the Financial Times or any kind of mainstream newspaper to see that inflation is rampant around the world. And where we've seen inflation for the most part with our business is around wages, labor. Because there's a shortage of skilled labor in Tanzania for the amount of projects that are being developed. You have Tanzania, you have Barrick's Bulyanhulu mine. I think they recruited about 600 or 700 people. They now have 2,000 people, I'm told, at between North Mara and Bulyanhulu. Those are nearly all Tanzanian, and unfortunately, some of those people have come from our operations. Barrick's willing to pay up to staff up, and then you have other projects in country that have received special mining licenses: Kabanga, Orcourt, Peak, and these projects are staffing up as well. And then there's the oil and gas sector. So the kind of the downside of a welcoming investment climate is there's investment and there's demand on labor, and particularly in a time when there's COVID, you can't have you have a restriction on movement of people. So typically West Africa or Western Australia, you'd have fly-in, fly-out operators to West Africa. That's been a problem because you can't get in and out of Western Australia. So in a nutshell, what has that done? That's added it's added inflation to the wage bill. And, we're not chasing salaries higher, but we certainly had to react to increasing salaries, and that's put that price up. In terms of equipment costs, yes, we're seeing inflation around equipment, particularly anything to do with steel or anything commodity based. has seen the cost of that go up. And unfortunately, gold miners are largely a price taker when it comes to equipment and inputs, particularly in an environment now where there's just there are challenges around supply chain. You don't have as much of a strong hand when everyone's trying to get their hands on equipment. So inflation is in the business. What's the natural mitigant that to get to that is the fact that the gold price is a lot higher than it was 2 years ago. What do you see as the main risk to bringing Singida into production? That's a good question. I mean, it's really being able to stick to plan and making sure that we have the availability of financing to meet the plan that we set out. And we believe that's mitigated through these three sources of liquidity: cash flow, and balance sheet capacity. But from my perspective, that's important. Now, as I said, there was a big de-risking event last week when we had the mining licenses extended for another 10 years. Our team is 100% Tanzanian, and we've got the backing of the government. They are super excited about Singida coming into production. So, hopefully with all that support, we won't have an issue. But development and construction always comes with its own risks, and we must be mindful of that. In terms of the next question from Justin, I think I saw 2.6 grams per ton expected for H1. Very rough calc. 220,000. I won't go through the calculation. What does it mean in terms of guidance? You're expecting H2 weighting. How conservative is that? What we've said in terms of the split of production for the year, about 65% will come of gold production will come in the second half of the year, and the balance in the first half of the year. And so, we know that that's a given. It's not a surprise to us. That's how we manage our cash flows, to make sure that when we spend the money, we can do it with confidence, and we can invest in places like Singida and West Kenya, knowing what our monthly liquidity looks like. And so that's just part of our forecasting period. In terms of Justin, a follow-up question, I assume the risk of supplier challenges is ever present in the current environment. Are we confident that suppliers are managing their supply chain challenges adequately? Are we taking mitigating actions to protect our production? Justin, great question. Supply chain hurt us in Q4. We had a supplier that, in South African language, didn't come to the party. They took far too long to fix a problem that I think should have been dealt with much sooner. We looked at penalizing them. We decided it wasn't in our best interest. And the way, for instance, we're mitigating that is we're putting more equipment into the supply chain than we had before. So we've added another charging unit. We've placed an order for another charging unit. Where we're trying to mitigate other supply chain challenges is by overstocking critical spares. We've seen things get hung up in the Dar es Salaam port. So we've added expediters, our own people into the port to expedite shipments that come off of boats. And, I've gone so far as to say to our team, if they see issues with supply in any parts of the world, that they think they can go and get parts themselves, to literally get on an airplane and go get it. Let's not wait around for suppliers to give us excuses. Let's be nimble, and let's be agile in our approach. And we're very aware of supply chain issues. You see it all the time in the UK and every other part of the world. There's labor shortages and supply issues, and that's going to be around for some time. And there's going to be inflation. It's just about making sure you're well protected against that. Paul's asked the question: what proportion of current cash costs are labor and fuel energy? Paul, you've asked a good question. From memory, I believe our labor bill is about I think it's just over about $1 million a month. So 12 to $14 million a year, which would be roughly about 20% of our costs. These are round numbers. Fuel and energy is, again, 350. I think I would have to put that at about $7 or $8 million a year. But again, don't pin me down on those, Paul. And so again, we've seen fuel prices go up. Guess what? We see that on our energy costs. It's one of those things. So hopefully that answers that question. Oh, one more has just popped up. Do you have any view on the gold price outlook? A lot of conflicting factors, uncertain macro environment. Not sure I'd like to predict it. Listen, I'm a gold bull. I wouldn't be in this business if I wasn't. And you just have to look at where the gold price is now. You can see what's happening in the technology sector. It's, hopefully it's having its day. I'm sorry if any of you are invested in technology, but you've all had a good run if you have been, and I think gold is it's gold's turn now to benefit. There's certainly a lot of macro drivers for benefiting gold. Things around Ukraine, North Korea doesn't seem to want to sit still, and then inflation is rampant. I mean, it's not going away. I just had my haircut on the weekend. I think the price was up 20%. At the local barbershop, and I can't see why they would ever decrease that price. So inflation is here. That's typically very good for gold. So I like to predict gold prices a lot higher, and really the way to think, I think, is not so much commodity prices higher, but it's really a debasement of the currency. So as there's more currency, this commodity prices, real assets are a better place to put your money. Gold being one of them. So we do have one more question from Justin. Singida extension, very promising. Would Tanzania like to see further investment development from Shanta and other opportunities? They certainly would. I would say that Shanta's, we're probably at our limit right now in terms of development, investment, capital, exploration. We've got our hands full, and I believe we're probably best served not to take on any new opportunities. Demanding more of our cash. So we'll leave that for now. So last question, I promise. If there's any more, I won't answer them. This one's from Paul. Many thanks. Final question for me. You've mentioned, I think, the extension of the Tanzanian licenses by 10 years, which is great news. Do we have the licenses required for West Kenya? Okay, yes, we do. The licenses at Singida are mining licenses. So those are a 30-year license, extendable twice for a total of 30 years. So 10 years initial, 10 years extension, 10 years extension. We've just started our first 10-year extension. So we're in year 10. And what's going to happen at West Kenya? Well, when we acquired the company in West Kenya in 2020, the prospecting licenses were extended for a fresh 9 years. And every 3 years, you have to forego half of your license holding. So we currently have about 1,200 square kilometers, which is a huge amount of area. I mean, I think that's just smaller than inside the M25. So if you think about what Yuri has to do every day, that's a lot of ground to cover. London and the home counties, and giving up half of that is probably not a bad thing anyway. So you naturally give up the areas which you don't think are prospective, and so that's what we'll be doing. I think it's in Q2 this year. So don't be alarmed to see, half the licenses at West Kenya handed back. That's natural. That's what happens anyway. That's in the law, and it's a good way to prioritize the land that you want to keep anyway. So that's what happens with prospecting licenses. That's it. I've been reminded from Mark. We will end the Q&A session now. Hopefully that answered everyone's questions. And guys, and ladies and gentlemen, I'm very interested in this year. I think it's a fantastic period for Shanta. We have this crown pillar coming on stream in Q2, which will go a long way to fund our capital plans. And we are responsible investors. We don't overspend. We do things prudently and we do things carefully. I'm a shareholder just like you. I want what's best for Shanta, and I'm here to hopefully deliver that for you. So thank you very much.
Eric, thank you for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected for your opportunity to provide your feedback in order that the management team can better understand your views and expectations. It's only take a few moments to complete, I'm sure will be greatly valued by the company. On behalf of the management team at Shanta Gold, we'd like to thank you for attending today's presentation, and good morning to you all.